If you invested in silver and you just watched it fall nearly 47% in 2 weeks, if you stared at $120, then blinked and suddenly saw the mid-60s. If you're wondering whether that crash destroyed the bull market or created the setup of a lifetime, then you need to pay very close attention right now. Because while most investors are frozen, watching price bounce between $78 and $85, the informed capital isn't panicking. It's positioning. COMEX inventories are shrinking. Open interest is towering. The gold to silver ratio is compressing. And February 26th is approaching faster than most people realize. The real question isn't, did silver crash? The real question is, what happens if the paper market blinks first? Welcome to the channel. If you're over 50 and you've lived through 1980, 2008, 2020, then you already know markets don't ring a bell before the big move. Go ahead and subscribe. Think of it as locking in your front door before a financial storm hits. And tell me in the comments, where are you watching from today? The phrase 3-day window sounds small. It sounds temporary. It sounds like something traders use to create urgency. But in commodity markets, 3 days can redraw the entire structure of supply and demand. He understood that markets do not move only because of price. They move because of timing. Contracts expire, margin requirements adjust, delivery notices are issued, liquidity tightens. When these events cluster together, short windows become decisive. Silver had just experienced weeks of volatility. After a powerful rally that carried it to historic highs, it corrected sharply. The drop was fast and mechanical. Margin increases forced leverage positions to unwind. Exchange-traded funds saw outflows. Algorithmic systems reacted to price momentum rather than fundamentals. To many observers, the correction looked like failure. To others, it looked like compression. They watched the price move between $78 and $85, unsure whether the market was stabilizing or preparing for another decline. Retail investors focused on candles and resistance lines, but professional capital was focused on something else entirely. The calendar. 3 days can matter when they coincide with contract rollovers. They matter when first notice dates approach. They matter when open interest remains elevated near expiration. They matter when exchange inventories are already under scrutiny. He knew that in futures markets, most participants do not intend to take delivery. They trade contracts for exposure, not for physical metal. As expiration approaches, they typically roll positions into the next month. This process usually occurs quietly. But when uncertainty rises, behavior changes. If a larger than usual portion of contracts chooses to stand for delivery, the exchange must provide registered metal. If inventories are limited, that demand creates stress. Not immediate collapse, but pressure. The 3-day window ahead was not about emotion. It was about alignment. Open interest was still significant. Registered inventory was finite. Delivery notices were imminent. In calm markets, this alignment passes without incident. In tight markets, it becomes a catalyst. He recognized that timing often reveals what price alone cannot. When markets are strong structurally, they absorb delivery cycles smoothly. When they are fragile, small disruptions amplify. Silver's recent crash had shaken confidence, but the crash itself did not erase the structural supply deficit that had developed over years. Industrial demand remained elevated. Mining output had not surged. Strategic accumulation had not reversed. The question was not whether silver had corrected. The question was whether the correction had resolved pressure or merely delayed it. 3 days can reveal that answer. Professional investors understand that liquidity is not constant. It expands and contracts around key dates. When margin adjustments occur close to delivery windows, weaker hands often exit. Stronger hands prepare. He observed that the strongest participants do not react at the moment of panic. They plan before it. They monitor contract rollovers. They track inventory reports. They evaluate whether stress is easing or building. For entrepreneurs and business leaders, this lesson extends beyond metals. Markets are ecosystems built on timing. Debt maturities cluster. Earnings reports cluster. Policy announcements cluster. Risk rarely arrives alone. It arrives in groups. Silver's 3-day window represented such clustering. He examined the components carefully. First, open interest in the near-term contract remained elevated relative to historical averages. Second, registered inventory levels had already been reduced in prior weeks due to withdrawals. Third, volatility had increased margin sensitivity. Individually, each factor is manageable. Together, they compress decision-making. If traders roll contracts early, pressure dissipates. If they hold positions into delivery, pressure builds. If margin requirements rise again, liquidity tightens further. 3 days can determine which path unfolds. He reflected on historical episodes where small windows defined trends. In commodity cycles, delivery months have often acted as stress tests. Sometimes they confirm strength. Sometimes they expose weakness. This moment carried similar characteristics. Silver's rally had been driven by multiple forces: industrial expansion, geopolitical uncertainty, and currency concerns. Its correction had been driven largely by leverage mechanics. The fundamental drivers remained in place. Yet markets are forward-looking. They demand confirmation. The upcoming window would function as that confirmation. If delivery pressure eased, the correction might extend into consolidation. If delivery pressure intensified, the market could interpret it as validation of physical tightness. He reminded himself that serious decision-makers do not rely on hope. They rely on structure. The structure ahead was clear: a limited inventory pool, concentrated contracts, and an approaching notice period. They did not need a crisis to understand significance. They needed only arithmetic and timing. Entrepreneurs watching from the outside may ask why this matters to them. It matters because silver is no longer just a monetary metal. It plays a central role in solar panels, electric vehicles, electronics, and data infrastructure. When its price shifts sharply, supply chains feel it. When its delivery mechanics tighten, manufacturers reassess procurement. 3 days in a futures market can ripple outward into production schedules and cost forecasts. He considered the broader macro backdrop as well. Interest rate expectations were shifting. Debt levels remained high. Currency stability was under constant debate. In such environments, commodities become more sensitive to delivery mechanics. A short window can amplify larger trends. He concluded that the 3-day period ahead was not about predicting catastrophe. It was about observing alignment. Would contracts roll quietly, signaling stability? Or would participants test delivery channels, revealing underlying stress? Markets often hide tension until specific dates expose it. Silver stood at such a date. The price between $70 and $85 was not the main story. The calendar was. He recognized that calm analysis is essential in moments like this. Fear exaggerates. Complacency ignores. Discipline observes. The next 3 days would not determine the fate of silver forever. But they could define the direction of the next phase. If the market absorbs delivery smoothly, confidence rebuilds. If pressure surfaces, the correction narrative changes. Timing, not headlines, would decide. And for those who understand markets at a structural level, that understanding creates advantage. Because in financial systems, trends rarely reverse without warning. They reveal themselves in compressed windows. And this 3-day window may be one of them. Silver's price movement created noise. The calendar created urgency. But the real story lived in the numbers. He turned his attention away from headlines and toward the exchange reports. Because in commodity markets, sentiment may fluctuate daily, but arithmetic does not. The exchange separates silver inventory into categories. There is eligible metal, stored in vaults, but not committed for delivery. And there is registered metal, the portion officially available to satisfy futures contracts. Only registered silver can meet delivery obligations. This distinction matters more than most investors realize. As of the latest report, registered inventory stood at a fraction of total open interest in the near-term contract. Open interest represents the number of active futures contracts. Each contract corresponds to a fixed amount of silver. When multiplied, it reveals the total ounces promised on paper. He performed this simple calculation. The exchange had roughly 28 million ounces of registered silver available. Against that stood open interest, representing hundreds of millions of ounces in potential claims. The coverage ratio, registered inventory divided by potential delivery demand, was low, not zero, not collapse, but tight. He knew that not every contract holder stands for delivery. In most months, the majority roll their positions forward before first notice day. The system functions smoothly because most traders seek price exposure, not metal. The system relies on that behavior. But when volatility increases, trust shifts. If even a small percentage of contract holders decide to take delivery instead of rolling forward, the pressure multiplies quickly. It does not require all contracts. It requires only enough to exceed registered supply. This is why the 3-day window matters. As first notice approaches, traders must decide, roll or stand. Rolling pushes demand into the future and relieves immediate stress. Standing demands metal now. He examined historical precedents. In prior delivery cycles, inventory stress did not always lead to default. Exchanges can raise margins. They can incentivize rolling. They can source metal. They can adjust spreads. Yet each of those tools signals strain. The key insight was not that collapse was inevitable. The insight was that the margin for error was thin. If registered inventory covers only a small percentage of open interest, the exchange depends heavily on contract holders choosing not to demand delivery. This works in stable environments, but silver had just experienced extreme volatility. Confidence had been shaken. When confidence weakens, more participants seek physical assurance. He considered the behavior of industrial buyers. Companies that rely on silver for manufacturing cannot risk supply disruptions. If they perceive tightness, they may prefer to secure metal early rather than depend on future availability. That shift alone can alter delivery dynamics. The arithmetic remained straightforward. If only 4% of open contracts demanded delivery, the exchange's registered inventory could be exhausted. 4%. He repeated that number carefully. It was not 40%. It was not majority demand, it was a small fraction. This is what transforms routine delivery cycles into potential stress points. The exchange can survive tight months. It has tools. But when coverage ratios narrow, market psychology changes. Traders begin asking different questions. Instead of asking, where will price move, they ask, is supply adequate? That change in question changes behavior. He also examined withdrawal trends. In prior weeks, significant quantities of silver had moved out of registered status. Some shifted to eligible. Some left vaults entirely. Withdrawals do not automatically signal shortage. They can reflect reclassification. But when they occur in large amounts within short time frames, they reduce immediate flexibility. Each withdrawal increases sensitivity. For entrepreneurs and business leaders, this may seem technical, but inventory arithmetic is a fundamental business principle. When liabilities exceed available stock, delivery risk emerges. When buffers shrink, timing matters more. Silver's futures market is no different from any supply chain. Promises exceed inventory until rollover behavior balances the system. If rollover behavior weakens, imbalance appears. He considered the potential outcomes during this window. Scenario 1. Open interest collapses before first notice day. Traders roll forward. Delivery demand remains manageable. Inventory stabilizes. The market breathes. Scenario 2. Open interest remains elevated. A meaningful portion stands for delivery. Registered inventory tightens further. Margins may increase again. Volatility rises. Scenario 3. Emergency sourcing occurs quietly. The exchange maintains order, but stress leaves a footprint in spreads and premiums. None of these scenarios require panic, but they require attention. Markets often telegraph structural shifts in subtle ways, rising physical premiums, widening arbitrage spreads, accelerated withdrawals. These are indicators. He watched for those signals rather than dramatic headlines, because default in modern markets is rare. Stress, however, is frequent, and stress, when combined with thin coverage ratios, amplifies trend changes. If the delivery cycle passes smoothly, silver may consolidate. If it reveals tension, it may reignite upward pressure as participants reassess supply security. The arithmetic does not predict price, it defines possibility. He reminded himself that disciplined analysis separates probability from certainty. A credible stress scenario is not the same as guaranteed crisis, but credible stress scenarios influence positioning. Professional capital does not wait for confirmation of crisis. It responds to narrowing margins of safety. Silver's inventory coverage represented such narrowing. He concluded that the 3-day window would not only test the exchange, it would test conviction. Will traders treat silver as a paper instrument, or will enough of them treat it as a physical asset to shift the balance? The answer lies not in sentiment, but in contract behavior, and that behavior will reveal itself quietly, in inventory reports, in open interest declines, and delivery notices filed. He understood that sometimes the most powerful signals are the simplest: promises versus ounces, contracts versus metal, arithmetic versus assumption. Within this window, that arithmetic becomes decisive, and from there, the analysis must move beyond inventory toward valuation. Because even if the delivery cycle passes without incident, the larger question remains: is silver historically expensive, or still structurally undervalued relative to gold? That dimension may matter even more than this delivery window itself. While traders debate delivery pressure and inventory coverage, a quieter signal continues to move beneath the surface. He shifted his focus away from vault reports and toward something older, something that has guided precious metals cycles for centuries: the gold-to-silver ratio. It is simple in form. It measures how many ounces of silver are required to purchase 1 ounce of gold. Yet within that simple calculation lies one of the most reliable long-term valuation signals in commodity history. At the moment, the ratio sits near the low 60s. To the casual observer, that number means little. To the disciplined capital allocator, it speaks volumes. Historically, the ratio has moved in wide arcs. During periods of monetary stress, it compresses sharply. During periods of stability or silver underperformance, it expands. He remembered that less than a year ago, the ratio briefly exceeded 100 to 1. That meant silver was historically inexpensive relative to gold. It represented extreme divergence. When such extremes occur, mean reversion often follows. And it did. As silver rallied powerfully, the ratio compressed. Not to 40, not to 30. It compressed only part of the way, toward the low 60s. The market corrected. Volatility returned. Yet even after the correction, the ratio remains well above historic compression lows. This matters, because the ratio does not require delivery stress, it does not require exchange drama, it reflects relative value. He studied past cycles carefully. In prior precious metals, bull markets, the ratio often compressed to 40 to 1, sometimes to 30 to 1. In extreme episodes, like 1980, it compressed even further. Each compression phase corresponded with silver outperforming gold dramatically. The current reading suggests the compression cycle may not be complete. He did not claim certainty. Markets do not follow identical scripts, but probability favors continuation when structural forces remain intact. If gold remains stable and the ratio compresses further, silver must rise faster. That arithmetic does not depend on headlines. It depends on historical pattern. He asked a simple question. If the ratio returns merely to 40 to 1, what does that imply for silver at current gold prices? The implication is significant. If it compresses to 30 to 1, the implication grows more substantial. These are not predictions. They are mathematical outcomes based on relative valuation. Professional investors often think in ratios rather than absolutes. They assess relative opportunity. At 100 to 1, silver was deeply undervalued. At 63 to 1, it remains elevated relative to historical compression zones. This suggests that even without a delivery crisis, silver may have room to outperform gold. He also considered behavior. Gold is typically favored during uncertainty. Silver often lags initially. Then, in later phases of a metal cycle, silver accelerates. Why? Because silver carries both monetary and industrial identity. When momentum builds, it attracts speculative and industrial demand simultaneously. The ratio captures that acceleration. He recalled that silver's recent rally outpaced gold significantly, yet the ratio still sits above historical compression lows. This means that despite volatility, the structural relationship has not reached extremes associated with cycle tops. For entrepreneurs and business leaders, the ratio offers strategic insight. If holding both metals, the ratio can guide allocation shifts. When silver is historically cheap relative to gold, overweight silver. When silver becomes historically expensive relative to gold, rebalance toward gold. The current environment suggests silver has not reached that rebalance threshold. This does not eliminate downside risk. Corrections occur, consolidations extend, but relative valuation remains supportive. He recognized that many market participants focus exclusively on short-term price movement. They ignore relational signals, yet relational signals often identify inflection points earlier than price charts alone. The ratio has compressed significantly from its extreme, but it has not completed a typical compression cycle. If this bull market continues, further compression would be consistent with precedent, and if further compression occurs, silver's upside potential expands. He emphasized discipline. The ratio does not move in straight lines. It fluctuates, it overshoots, it corrects, but over full cycles, it reveals structural rhythm. Silver's current position within that rhythm suggests continuation rather than exhaustion. He connected this insight back to the 3-day window. Even if delivery pressure passes quietly, even if volatility subsides, the ratio may continue compressing. The window may act as confirmation rather than catalyst. If silver stabilizes and the ratio resumes compression, confidence builds. If silver weakens sharply and the ratio expands again, caution increases. The ratio functions as a second dimension of analysis, independent of exchange arithmetic. Together, delivery dynamics and ratio compression create a layered view. One measures physical stress, the other measures relative valuation. Both currently lean supportive. He did not claim inevitability, he claimed alignment. When multiple independent indicators point in the same direction, probability strengthens. The ratio is not shouting, it is whispering. And those who listen carefully may recognize that silver's story is not defined solely by its recent crash. It may be defined by where it stands within a longer historical arc. If that arc continues to bend toward compression, the next leg may not require dramatic headlines. It may unfold quietly, steadily, until the ratio approaches levels that have historically marked culmination. For now, it remains elevated enough to suggest the journey may not be complete, and that realization shifts the focus toward the final dimension. If silver's structure remains intact and relative value supports continuation, how are the companies that mine silver priced in comparison? Because leverage, when applied to metals, often resides not in futures contracts, but in operating businesses. That is where the analysis must now turn. Silver's price tells one story, the delivery window tells another, the ratio whispers its own message. But beneath all of it lies the most powerful layer of the cycle, operating leverage. He shifted his focus from contracts and ratios to companies, because when metals move, mining businesses amplify the move. A silver miner does not simply mirror price, it magnifies it. Most primary silver producers operate with all-in sustaining costs between $15 and $20 per ounce. When silver trades near $80, their gross margin per ounce is substantial. When silver trades at $100 or $120, that margin expands dramatically. The difference between $80 and $120 is not a 50% increase in earnings. It can be a doubling or more. This is why mining equities behave differently from the metal itself. He examined the numbers calmly. At $80 silver, a miner with a $20 cost base earns roughly $60 per ounce before taxes and corporate overhead. If silver rises to $120, that margin increases to $100 per ounce. That is not incremental. That is exponential at the income statement level. Yet, despite this arithmetic, many silver mining stocks remain below prior highs. They corrected sharply during the recent crash. Fear compressed valuations faster than fundamentals changed. The market reacted to volatility, not to cost structure. He understood this dynamic clearly. Markets often punish leverage during corrections. Investors recall past cycles where miners underperformed due to debt, hedging, or political risk. But not all miners are equal. The companies best positioned for continuation share four characteristics: low production costs, minimal debt, stable jurisdictions, limited hedging exposure. These businesses convert price strength directly into cash flow. If silver merely stabilizes at current levels, they remain profitable. If silver advances, they transform into powerful cash generators. He studied the miner to metal ratio as well, the relative valuation of mining equities compared to the silver price itself. That ratio sits near historically low levels. This suggests that while silver rallied strongly, mining equities have not fully priced in sustained margins. Investors remain cautious. Caution creates opportunity when structure supports continuation. He also considered the broader macro backdrop. Interest rate expectations are shifting. Monetary policy is gradually easing after a tightening cycle. High sovereign debt levels limit how restrictive policy can remain for long. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. At the same time, currency purchasing power remains under long-term pressure. Debt growth continues. Fiscal deficits persist. In such an environment, hard assets regain attention. Silver carries an additional layer: industrial demand. Solar expansion continues. Electric vehicle production expands. Data centers require silver and circuit infrastructure. Advanced electronics rely on its conductivity. Industrial demand has consumed an increasing percentage of global production. This is not speculative demand. It is functional. If industrial consumption remains elevated and supply growth remains limited, the structural deficit persists. He connected this to mining economics. When structural deficits exist, new supply does not appear quickly. Developing new mines requires years of exploration, permitting, and capital expenditure. Short-term corrections do not instantly increase production. This creates asymmetry. If demand remains stable and supply growth is constrained, even modest investment inflows can lift price. And when price lifts, mining margins expand disproportionately. He did not ignore risk. If the dollar strengthens meaningfully, if interest rates rise sharply again, if industrial demand slows unexpectedly, silver could face extended consolidation. Mining equities, being more volatile, would react strongly. This is why disciplined positioning matters. Professional capital does not allocate without scenario planning. He outlined the positioning framework calmly. Physical holders benefit from reduced counterparty risk. ETF holders must evaluate structure and custody. Equity investors must analyze cost structures and balance sheets. Each layer carries opportunity and risk, but what makes this moment distinctive is alignment. A compressed delivery window, a supportive gold to silver ratio, a structural supply deficit, operating leverage embedded in mining companies, macro policy leaning toward accommodation rather than restriction. Individually, none guarantee continuation. Together, they create probability. He returned to the 3-day window. If delivery pressure intensifies, sentiment may shift rapidly. If delivery passes smoothly, confidence may rebuild gradually. Either outcome does not erase structural fundamentals. Markets often require a moment of tension before direction clarifies. This window represents such a moment. He considered history. In prior cycles, violent corrections occurred mid-trend. They shook confidence. They forced weak hands to exit. They reset leverage. Then the next leg began, not because of hope, but because structure remained intact. The recent silver crash was mechanical in nature. Margin increases and leverage unwinds accelerated selling. Yet industrial demand did not collapse. Supply did not surge. Structural deficits did not disappear. He concluded that the most dangerous mistake is confusing mechanical correction with structural reversal. Entrepreneurs understand this principle well. A temporary cash flow squeeze does not define the long-term viability of a business. Structural profitability does. Silver's structure remains defined by scarcity and demand. If the 3-day window confirms stability, the next phase may begin quietly. If it reveals stress, volatility may return, potentially to the upside. He ended with discipline rather than drama. The opportunity does not arrive with certainty. It arrives with tension. It appears when numbers align, but confidence wavers. This may be such a moment. Silver holders face a decision, react to fear, or analyze structure. The arithmetic of inventory, the mathematics of ratio compression, the economics of mining leverage, and the reality of macro debt all converge within this narrow window. 3 days may not define the entire cycle, but they may define the next chapter. And in markets, chapters often determine fortunes long before headlines recognize what has changed.